Okay, we're going to begin a lecture on Chapter 8, which is reporting and analyzing receivables. And we're going to go over the learning objectives in a few minutes that are presented by the publisher in the chapter, but I'll tell you a couple of things. Number one, it's really important, like any other chapter, is to be able to record the transaction. And I said this at the very beginning of the semester, in that financial accounting is all about recording transactions, because every transaction in business ultimately results in a journal entry that needs to be recorded. Journal entries record the transactions. We culminate all of those journal entries into financial statements ultimately. So understanding transactions and preparing journal entries is the essence of financial accounting. And in this chapter, we're talking about reporting and analyzing receivables. And receivables come in the form of accounts receivable and notes receivable. Receivables are things that a company is entitled to receive as a result of some type of exchange. And three basic things that you really need to understand in addition to the other objectives is, number one, you need to be able to prepare journal entries to record sales transactions. A company sells a product. You need to be able to record the transaction for the sale. As companies record sales, they record receivables, amounts that are owed to them. And there's a possibility that the company will not be paid at some point in time. And those are called bad debts. You need to be able to understand how to account for bad debt expense, how to create some type of allowance for the possibility of those receivables not being collected. So we're going to talk about bad debt expense and the allowance for uncollectible receivables. And then lastly, in this chapter, we're going to revisit a chapter 4, where we talk about preparing adjusting journal entries. And if you remember, an adjusting journal entry is different than a journal entry. A journal entry records a transaction. An adjusting journal entry makes adjustments to the accounts. And an adjusting journal entry always includes an income statement account and a balance sheet account, but never cash. So we're going to prepare adjusting journal entries to accrue interest receivable. So those are the three big things in this chapter, but there are some other smaller items that are just as important. So let me share my screen with you, and we will begin the PowerPoint presentation for this chapter. Again, this is Chapter 8. Kimmel, Chapter 8, 7th edition, reporting and analyzing receivables. Here are some of the learning objectives we talked about. Explain how companies recognize accounts receivable. Secondly, describe how companies value accounts receivable and record their disposition. Thirdly, explain how companies recognize, value, and dispose of notes receivable. And number 4, describe the statement presentation of receivables and the principles of receivables management. Let's look at objective number 1, how companies recognize accounts receivable. Types of receivables. We have accounts receivable, which are amounts customers owe on account that result from the sale of goods and services. A note receivable is a written promise, formal instrument for amount to be received. And there are some other receivables, non-trade receivables, such as interest receivable, loans to officer, loans or advances to employees, and income taxes refundable. Amounts due from individuals in companies that are expected to be collected in cash. So here are some significant companies that you may be aware of. And looking at the percentage of receivables as compared to total assets, you can see a company like Ford Motor Company. 43% of their assets represent some type of receivable. So receivables are a material, a significant item on a company's balance sheet. Recognizing accounts receivable, service organizations record receivables when they perform a service on account. I'm a CPA. I prepare financial statements and tax returns for clients. And when I perform those services, especially with a client that I've known for a long time and their credit history is good with me, that means they've always paid me, I will extend them credit. What does that mean? Well, it means I will prepare their tax return, deliver their tax return to them, bill them. Let's assume I bill them $300 for the preparation of a tax return. I will send them an invoice for $300. I have now a receivable. I have an asset. I'm entitled to collect something from a client. So that client, maybe 30 days later, 45 days later, 60 days later, will send me a check in payment of that receivable. I'm a service organization. Merchandisers, okay? Merchandisers are what? Companies that sell stuff. Merchandisers record accounts receivable at the point of sale of merchandise on account. In other words, when title transfers. A seller may offer a discount to encourage early payment. We saw that, something like 210 net 30, get a 2% discount if they pay the bill within 10 days. Otherwise, it's due in 30 days. Here's an example. Assume that Jordache Company on July 1, 2022 sells merchandise on account to Polo Company for $1,000, terms 210 net 30. Prepare the journal entry to record this transaction on the books of Jordache. So they have a sale, okay? Title transferred. Debit accounts receivable, credit sales revenue. An entry that you should be familiar with. On July 5th, Polo returns merchandise worth $100 to Jordache, okay? Sales, returns, and allowances, and they're no longer entitled to the $100 to be paid. Lastly, on July 11th, Jordache receives payment from Polo Company for the balance due. So paid within 10 days, paid on 10 days. So they're entitled to the discount. So they receive cash. The original receivable was $1,000. They returned $100 worth of merchandise. So they're owed $900, but they get the 2% discount. 2% of $900 is $18. So they receive cash of $882. The entire receivable will be wiped out, the entire $900, and you have a debit to balance the transaction. Remember, debits always have to equal credits. Sales discounts, $18. Recognizing receivables. Some retailers issue their own credit cards. Assume that you use your JCPenney credit card to purchase clothing with a sales price of $300 on June 15th. There's a sales transaction, which you're comfortable with at this point. If you still owe the $300 from June 15th transaction at the end of the month, JCPenney charges interest at 1.5% per month. Now, generally speaking, interest, unless otherwise stated, is reflected as an annual percentage rate. This is not 1.5% per year. This is 1.5% per month, okay? On the balance due, JCPenney makes an adjusting entry to record interest revenue on June 30th as follows. So let's remember, an adjusting journal entry affects an income statement account and a balance sheet account, but never cash. So JCPenney is entitled to receive some interest. They haven't collected it yet, though. They have a receivable. They have a receivable for the interest, and they have interest revenue. How do we calculate it? The balance is $300. It's 1.5% per month, and it's outstanding for 1/2 of the month, $2.25. Adjusting journal entry, right? Balance sheet account, income statement account, never cash. The balance sheet account is accounts receivable. The income statement account is interest revenue. On May 1, Wilton sold merchandise on account to Bates for $50,000, terms 315. 3% if paid within 15 days. Net 45, otherwise all due in 45 days. On May 4th, Bates returns price of $2,000. On May 16th, Wilton receives payment from Bates for the balance due. Prepare the journal entries to record the May transactions on Wilton's books. Ignore cost of goods sold transactions. Here's my initial recording of the sale. Here's the return of the product. Again, this is a familiar topic. We looked at it in Chapter 5, merchandising transactions. And here's the payment, right? They originally owed them $50,000. They returned $2,000 worth of merchandise. So they only owed them $48,000, hence the credit to accounts receivable. They took the discount of 3%, $48,000 times 3% is $1,440. So the discount is $1,440. The net cash is $46,560. Let's look at learning objective number 2. Describe how companies value accounts receivable and record their disposition. Valuing accounts receivables valued at net realizable value. In many companies, not all the accounts receivable will be collected. Some of them will not be collected. Some customers will not pay for whatever reasons. They go bankrupt, they go out of business, they just don't pay for whatever reason. Sometimes it's uncollectible. Uncollectible accounts receivable. Sales on account raise the possibility of accounts not being collected. The seller records losses that result from extending credit, reported as bad debt expense. Company has to value, has to look at their receivables periodically and determine what may not be collectible. There's 2 methods, the direct write-off method and the allowance method. The direct write-off method is not GAAP. It's not part of generally accepted accounting principles. We're going to look at it, but we're not going to use it a lot because it's not permitted. The allowance method, better matching. What does that mean, matching? Remember the matching principle. The matching principle states you need to match expenses with revenue. So you need to record that bad debt expense in the same accounting period as the receivable occurred. That receivable may be uncollectible at some later date, a year down the road, but we need to make some sort of estimate where we provide for the possibility of it not being collected. We need to record the bad debt expense in the same period as the revenue. Receivables stated at the net realizable value, what they believe they can collect. Direct write-off method, again, which is not permitted. Assume that Ward & Company writes off M.E. Doran's $200 balance as uncollectible on December 12th. See what happens there? You got an expense and you have write-off against the receivable. You're removing the receivable from the books and recording the expense. But this is not acceptable for financial reporting unless bad debt losses are insignificant. And we already proved that receivables are significant. Chances are bad debts are also significant. Features of the allowance method for uncollectible. Estimate uncollectible accounts receivable. This is an estimate. Now, a lot of people claim that a financial accounting or accounting is very precise, very accurate. It is indeed. However, there are an awful lot of estimates that occur. This is one significant estimate that's here. This is not really what happened. This is an idea, an estimate, a projection, a forecast of what possibly could happen. An estimate of uncollectible accounts receivable. To record the transaction, we're going to debit the bad debt expense and credit, not the receivable, but an allowance for doubtful accounts. Allowance for doubtful accounts is a credit to a contra asset account. At the time the specific account is written off, then you debit allowance for doubtful accounts, credit the accounts receivable. So when we determine the estimate, we have the first transaction, debit the expense, credit the allowance account. When we ultimately determine, maybe 6 months later, a year later, that receivable is uncollectible, that's when we debit the allowance account and credit the accounts receivable. We'll see plenty of examples. Recording an estimate for uncollectibles. Hampson Furniture has credit sales of $1.2 million in 2022, of which $200,000 remains uncollected at December 31st. In other words, The accounts receivable balance at December 31st is $200,000. The credit manager estimates that $12,000 of these sales would prove uncollectible. See the journal entry. This is an adjusting journal entry, right? Because it affects an income statement account and a balance sheet account, but never what? Cash. Debit the bad debt expense for $12,000. Credit the allowance for doubtful accounts. The allowance for doubtful accounts is a balance sheet account. It is a contra asset account. You can see it has a normal credit balance, where assets have a normal debit balance. This is what a part of the balance sheet would look like, specifically the items in red. The accounts receivable balance, as we said, was $200,000. The allowance account, contra asset account, reduces the receivable. The net realizable value of those $200,000 is estimated to be $188,000. Write-off of the uncollectible account. On March 1, 2023, Hampson Furniture writes off $500 owed by R.A. Ware. The entry to record the write-off is as follows. We took the bad debt expense in the previous accounting period, 2022. Here's where we ultimately determine that a particular receivable is uncollectible. We're going to write off that receivable now. This journal entry does not affect the income statement, does not affect bad debt expense. We're reducing the allowance because we made provision for this in a previous accounting period. So we debit the allowance for doubtful accounts, write off the receivable with the credit. On July 1, R.I. Ware pays the $500. So we wrote it off, but now maybe this customer wants to buy some additional product from us. And we say, we're not going to ship you any additional product until what? Until you pay what you owed us from the previous transaction. So two things have to happen here. Number one, we have to reinstate the receivable. And number two, we record the payment of cash. That July 1st entry, reinstate the receivable, debit accounts receivable, credit the allowance account, and then record the payment of cash. They received the cash, reduce the receivable. We have, in essence, restored the balance in the allowance account. This is an example of a footnote that would be seen in the financial statements. Feel free to read it. Estimating the allowance using the percentage of receivables basis. So we need to come up with the estimate somehow. Somebody, in the previous example, somebody gave you the estimate. It was $12,000, but how do you come up with it? So this is here, estimating the allowance using the percentages of receivables basis, basing estimates on outstanding receivables. Management establishes a percentage relationship between the amount of receivables and the expected losses from uncollected accounts. The amount of the bad debt expenses recorded is the difference between the required balance and the existing balance. This is important because the balance sheet account, allowance for doubtful accounts, is a permanent account. It means it never closes, so it always has a running balance in it. So we need to determine, number one, what is the existing balance and compare it to what is required to be there. That's where our adjusting journal entry comes into play. Here's an example of an aging of accounts receivable. And you can see they have a total of $39,600 in receivables. And they want to know, they're trying to estimate what portion of the $39,600 is uncollectible. So they have determined that there is a relationship between how old a receivable is and how well it's going to be collectible. In other words, the older the receivable, the greater the chances are it won't be collected. So you can see in column C, you got $27,000 that's not yet due, okay? Probably 210 net 30, okay? Probably only less than 30 days old. So they say, look, it's not yet due. Only 2% of those are uncollectible. But you can see as the receivable gets older, a comparison between the date of the sale and what the current date is. That's how they get the number of days. The older it is, the greater the chances of it not being collected. Look at that last column, G, over 90 days. 40%, they estimate 40% of those to be uncollectible. So in this example, they have calculated that a total of $2,228. So they're saying of the existing balance in receivables of $39,000, $2,228 is uncollectible. In other words, that's what the balance should be in the allowance account, $2,228. Let's look at an example. The unadjusted trial balance shows allowance for doubtful accounts with a credit balance of $528. So it presently has a balance of $528. However, it has to have a balance of $2,228. Prepare the adjusting entry assuming $2,228 is the estimate of uncollectible receivables from the aging schedule. The balance should be $2,228. It's only $528. Debit the bad debt expense for $1,700. Credit the allowance account for $1,700. You can see the two T accounts. On the right-hand side, the allowance for doubtful accounts has a credit balance now of $2,228. That's what the balance should be. Let's look at another example. Assume that the unadjusted trial balance shows allowance for doubtful accounts with a debit balance of $500. Not a credit balance, a debit balance of $500. It should be a credit balance of $2,228, right? See why we have to have a debit to the bad debt expense for $2,728 and a credit to the allowance account for $2,728, because the balance needs to be a credit balance of $2,228. Important concept. Here's another footnote that could show up with regard to the possibility of uncollectible receivables. Again, feel free to read it. Another example. Brule Company has been in business for 5 years. The unadjusted trial balance at the end of the current year shows the following. Accounts receivable, $30,000 debit. Sales revenue, $180,000 credit. Allowance for doubtful accounts, $2,000 debit. Be very, very careful. If it's a debit or a credit, has a significant impact on your journal entry. Bad debts are estimated to be 10% of receivables, not 10% of sales revenue, 10% of receivables. 10% of receivables is 30,000 times 10%. The balance should be $3,000 in the allowance account. It should be a $3,000 credit. It's currently a $2,000 debit. See the journal entry? You currently have a debit balance in the allowance account. You need to have a credit balance of $3,000. You need to credit the allowance account for $5,000. You have to bring the allowance account to where it should be. Sales of receivables to a factor. So we're done with bad debt expense. Sales of receivables to a factor. What's a factor? A method of disposing of accounts receivable. Receivables are sold to a finance company or a bank. Why? Factors buy receivables from businesses and then collect payments directly from customers. In other words, if you're factoring your receivables, if a company is factoring their receivables, they're selling their receivables to get cash right now. They may generate a $10,000 receivable today. They may not want to wait 30 days to get it collected. They'll sell it, get their cash immediately. It's good for cash flow. Typically charges a commission to a company that is selling the receivables. Fees range from 1% to 3% of the receivables purchased. Here's an example. Assume that Hendren Furniture factors $600,000 of receivables to Federal Factors. Federal Factors assesses a service charge of 2% of the amount of receivables sold. $600,000 times 2% is the service charge. They're selling the receivables, so they get rid of the receivables. reduce the asset with a credit. They have a service charge. $600,000 times 2% is $12,000. The net cash they receive is only $588,000. They sold their receivables. They received the cash right away. National credit card sales. A method of disposing of accounts receivable. Retailer pays the card issuer a fee of 2 to 4% of invoice price. Recorded same as cash sales. Advantages to the retailer. Issuer does the credit investigation of the customer, right? Everybody has a credit card. Everybody uses a credit card. The company doesn't have to worry about collection. The credit card company deals with that. Issuer maintains customer accounts. Issuer undertakes collection and absorbs losses. The company receives cash more quickly. Here's an illustration. Anita Ferrara purchases $1,000 of sound equipment for her restaurant from Karen Kerr Music Company using her Visa First Bank card. First Bank charges a service fee of 3%. This is a transaction that Karen Kerr Music, right? Anita Ferrara purchases $1,000 of sound equipment for her from Karen Kerr Music. Karen Kerr Music is the seller. This is the transaction that the seller records. They have sales revenue of $1,000, but they had to pay a service charge. But they get their money right away. They don't have to wait 10 days, 15 days, 30 days. They get their money the next day, most likely. They receive $970 in cash. They don't have to worry about bad debt expense. The credit card company worries about bad debt expense. Peter Kell Wholesalers Company needs to purchase $120,000, has to raise $120,000 in cash, safely cover next Friday's payroll. Kell has reached its debt ceiling. It can't borrow any money from anybody else. Kell's present balance of receivables is $750,000. Kell's decides to sell $125,000 of its receivables on September 7th to alleviate this cash crunch. Record the entry that Kell would make when it raises the needed cash. So they're getting rid of some of their receivables, hence the credit to accounts receivable, to raise cash. They can't wait 15 days. They can't wait 30 days. They need the money right now. They receive a cash, $123,750 after paying a service fee of only 1%. Explain how companies recognize value and dispose of notes receivable. This is not accounts receivable, these are notes receivable. Nature of a note receivable. Companies may grant credit in exchange for a promissory note. Promissory note is a written promise to pay a specified amount of money on demand or a definite time. Promissory notes may be used when lending or borrowing money, when amount of transaction and credit period exceed normal limits, in settlement of accounts receivable. May have an accounts receivable. Company may have a receivable of $10,000. It's gone beyond the collection period of 45 days, 60 days. So rather than keep it as accounts receivable, they convert it with the consent of the customer to a note receivable, which will entitle them to some interest income as well. Here's an example of a handwritten note. They are clearly much more complex than this, 4x6 piece of paper. To the payee, the promissory note is a note receivable. To the maker, a promissory note is a note payable. Determining the maturity date. Maturity date of a promissory note may be stated in one of three means. On demand, it means anytime. On a stated date, at the end of a stated period of time. Note the terms are expressed sometimes in months or days. Calculating interest is an important concept, important aspect in this chapter. Principal times interest times time. P, principal, or the face amount of the note. The interest rate, annual interest rate. Remember, the interest rate is always assumed to be an annual interest rate unless otherwise stated. The amount of time. When counting days, omit omit date note is issued, but include the due date. So here are some examples of interest calculations. The first line, the principal amount, $730. The annual interest rate is 10%. It's outstanding for 120 days. 730 times 12% times the amount of time, 120 divided by 360. We use 360 days as opposed to 365. It's a common aspect. Second note, $1,000 of principal, 9% annual interest. It's outstanding for 6 months. 6 divided by 12. And then the last one, $2,000, 6% per year. It's outstanding for 1 year. Again, the interest rate is always assumed to be annual percentage rate unless otherwise stated. Calhoun Company wrote a $1,000 2-month 12% note dated May 1st to settle an open account, a receivable. Prepare the entry Wilma Company makes for the receipt of the note. So they're exchanging a receivable for a note. Remove the receivable, increase the note receivable. The exchange there was they're exchanging an accounts receivable for a note receivable. Exchanging one asset for another. Report short-term notes receivable at their cash or net realizable value. Estimation of cash realizable value and recording bad debt expense and related allowance are similar to accounts receivable. So we need to provide for possible uncollection or uncollectibility of a note as well. Disposing of a note receivable. Notes may be held to the maturity date. Maker may default and payee must make an adjustment to the account. Holder speeds up conversion to cash by selling the note receivable. So there are various ways to get rid of it. Disposing. Honor of notes receivable. A note is honored when its maker pays it in full at its maturity. Dishonor. A dishonored note is not paid in full at maturity. Dishonored notes receivable are no longer negotiable. Here's an example of an honored note receivable. Wolder Company lends Hingley $10,000 on June 1, accepting a 5-month, 9% interest note. If Holder presents the note to Hingley Inc. on November 1, maturity date, Wolder's entry to record is as follows. Held for the entire period, right? $10,000, 9% a year, times 5 months out of the 12 months, $375. Dates are important. Signed on June 1, matures on November 1, 5 full months. June, July, August, September, October, 5 full months. Suppose instead that Wolder Company prepares financial statements as of September 30th. The adjusting entry by Holder is for the 4 months ended September 30th. Adjusting journal entry. Income statement account, balance sheet account, but never cashed. In this example, Wolder needs to accrue something that's owed to them, interest receivable. But how much is it? $10,000 times 9% for 4 months, right? June, July, August, September, 4 months. They haven't received the cash, but they're entitled to it. Debit an asset, interest receivable, credit an income statement account, interest revenue. Prepare the entry Wolders would make to record the honoring of the Hingley note on November 1. So now they get paid. They receive cash of $10,375. They got an additional 1 month's worth of interest, right? Because you accrued 4 months, July, August, September, October. I'm sorry, the other way, June, July, August, September. 4 months were accrued at September 30th. The last month is October. for $75. Received. The best way to handle this transaction is put down what you know first. The note receivable is easy, the credit for $10,000. The interest receivable is also easy because you just calculated it in the previous example. You got that one more month, so you got the total of 5 months, $75. Total them all up because your debits have to equal your credits. Dishonored note. Assume that Hingland's November 1 indicates that it cannot pay at the present time. If it does not expect eventual collection, Waldo Company would make the following entry at the time of the note is dishonored, assuming no previous accrual of interest. In other words, reinstate, the note's no longer negotiable, reinstate the accounts receivable, accrue the interest revenue that they'll possibly get. If instead of November 1 there is no hope of collection, the note holder would write off the face value of the note by making the following entry at the time the note is dishonored, assuming no previous accrual of interest. So what are you doing there? You're writing off the note against the allowance account. In theory, you provided for this bad debt expense in the previous accounting period. So if a dishonored note, there's no chance of being collected, just write it off against the allowance account. Gambit Stores accepts from Leonard a $3,400 90-day 6% note dated May 10th in settlement of Leonard's overdue open account. The note matures on August 8th. What entry does Gambit make at the maturity date, assuming Leonard pays the note and interest in full at that time? How much interest were they entitled to, right? $3,400 times 6% a year. It was outstanding for 90 days of the 360 days. They're entitled to 51 days worth of interest. There's your journal entry. Credit the note receivable because it's been honored. Recognize $51 of interest revenue. Total cash $34.51. Again, debits always have to equal credits. Describe the statement presentation of receivables and the principles of receivables management. This is what a receivable section could look like if you have various types of receivables. Receivables from unconsolidated subsidiaries, trade accounts receivables, notes receivable, financing receivables. You know, they sell trucks and they have financing plans with notes probably. Restricted financing receivables, other receivables. They have an allowance for doubtful trade receivables, $175. Net receivables, net realizable value. 5 steps, so company issues credit. 5 steps in managing accounts receivable. Determine which customers to extend credit to. They have to be credit worthy. Don't just give credit to anybody. Who is credit worthy? Establish a payment period. When is it due? Monitor collections. Evaluate the liquidity of receivables and accelerate cash receipts from receivables when necessary. In other words, sell them if you have to. Provide incentives for early payment. If the credit policy is too tight, customers and sales will be lost. If the credit policy is too loose, that means if you give credit to everybody, sales may be made to customers who will pay either very late or not at all. It is important to check references on potential new customers and check the financial health of continuing customers. So you got to check in on them once in a while. Every year or so, look at them and see if they're credit worthy. That's a whole other lecture. Managing receivables with payment periods. Companies should determine a required payment period and communicate that policy to their customers. Payment periods should be consistent with that of its competitors. Monitor collections. Prepare an accounts receivable aging schedule at least monthly. Helps managers estimate timing of future cash inflows, cash budgeting. Provides information about collection experience of company and identifies problem accounts. Significant concentrations of credit risk must be disclosed in the notes of the financial statements. Here's a couple of ratios. These are very similar to inventory turnover and days in inventory. This is accounts receivable turnover and average collection period. two ratios that you need to be responsible for. Accounts receivable turnover, net credit sales divided by average net accounts receivables, right? Average beginning ending divided by 2. Net after the allowance for doubtful accounts. And then the collection period, 365 days per year divided by the accounts receivable turnover. You can see here, we're looking at Nike. Their accounts receivable turnover is 9.9 times. So that means their receivables turnover 9.9 times per year in 2017. In 2016, it was 9.8 times. So they're getting a little bit better, right? The higher the number, the better. It turns over more. Competition, Skechers, their receivables turn over 10.6. So they're not as good as their competition. Average collection period for 2017. It took 36.9 days. In 2016, 37.2 days. So again, they're doing a little bit better. It takes them on average 36.9 days to collect their receivables. Skechers, again, doing better. It only takes them 34 days. Accelerating cash receipts. 3 reasons receivables are sold. Size of the receivable. Don't want to hold on to it too long. Maybe the only reasonable source of cash. And billing and collection are often time-consuming and costly. So just sell them to a factor, let somebody else deal with it. So again, this is a summary or chart of how we manage our receivables. Determine to whom to extend credit. Determine the payment period, 15 days, 30 days, 45 days. Monitor. Hi, you owe our money, company money, so you're going to call those people. Find out when they're going to pay you, evaluate your liquidity, and consider selling them when needed. Here's an analysis. Here's another calculation. LeBron James Company had net credit sales of $923,000 for the year. It had a beginning accounts receivable balance of $38,275, an ending of $35,988. Compute LeBron James's accounts receivable turnover and average collection period in days. So A is the accounts receivable turnover, net credit sales of 923, divided by the average receivable balance, beginning plus end divided by 2, 24.9 times. The receivables turn over 24.9 times a year. B, how many days does it take to collect? 365 days divided by the turnover takes them 14.7 days on average to collect their receivables. And that's it. We're not going to talk about objective number 5. So that is chapter 8, reporting and analyzing receivables. Hope that was helpful. And thank you very much.